So again, guys, good morning. There isn't a problem with your screens. We are just waiting for a few more people to be let into this morning's webinar. And we're going to make sure that we get as many people in so we can kick this off as quickly as possible this morning. It is a pleasure to have you here with us. Obviously, we've got quite a few states in lockdown. So guys, thank you for joining us. We do hope that you are doing well during this time. And keep in mind that if there is anything that we can do to help, give me a call and let me know, even if it's just a giggle that you need or someone to talk to. Definitely here to help, and so is Mark over on the West Coast. So please do make sure that you give us a call or you reach out. Hopefully by now you've also changed your passwords into the new member section on the website. It's really exciting that we launched that 2 weeks ago as well. But make sure that you do log into the new members area and you get those passwords changed. In there, you will be able to do all the administration humanly possible for your FBAA membership, right through to renewing your membership and tracking your CPD. So make sure that you have gone in there and updated all of your details and logged in. The username and password was issued to you on an email, but just as a reminder, your username is your FBAA membership number and your password is your email address. So it's quite easy to get in the first time. Then just change your password once you're in there, and you'll be on your way into using the new members area, and you'll find out that it has become the membership superhighway to end all superhighways. You will live and breathe all things FBAA in there. We'll also have some important urgent communications coming out to you shortly in regards to the national conference, and we'll keep you updated very soon about that. Keep in mind, last week you were also issued with the notification that the AGM and board nominations have been sent out, and we'd like those filled in if you want to have a look at joining the board of directors, or if you're interested in joining one of our state councils, please let Mark or myself know, and we will get you in contact with the right people for this as well. So guys, I am going to kick it off with 3 minutes past starting point, and I like a quick game, as everybody knows as well. So thank you very much for joining us for this morning's webinar. My name is Leah Renwick. I am the East Coast Manager for the FBAA, and if it's our first time seeing you on one of these, welcome, and we hope that you have a great time with us. Today we're going to be joined by Donelle Brooks, the Head of Third Party at Lend, who will be presenting on business loans and what do they really cost. Donelle will also be joined by Finance Specialist and Lend Partner, Mark Munchenberg. Shortly, I'm going to pass you over to Donelle. However, just to let you know, should you wish to ask any questions at all during the presentation, please provide these in the chat box on your control panel for the webinar. Donelle will then go through these questions at the end of the webinar, either verbally or by responding to you directly. Please also note that we are experiencing some issues with the internet due to the whole wide world jumping onto webinars now. So it does cause sometimes some lags and some interruptions to happen, but bear with us either way. The recording will go onto the FBAA YouTube channel following this, and you'll receive the link in the follow-up email that is sent with the CPD code. So Miss Donelle Brooks, I'm actually going to ask you to join me via your webcam now.
Good morning, Leah.
Good morning. It's great to see you this morning, and you're looking well. I mean, obviously we've got some beautiful sunny weather, although windy happening outside. So hopefully you're nice and warm down on the Gold Coast as well.
I certainly am, and it's really nice to see you, even though we are only just down the highway from each other, but it is nice to see you. And welcome everyone to our first webinar this year, actually, with the FBAA. So we're really excited. This one has been super popular. It's a question that a lot of brokers don't like to ask because they almost feel like they're expected to know. So I'm really grateful to have Mark with me today, who can sort of dive in and help me explain some of those rates.
Fantastic. Donelle, I'm going to hand everything over to you and leave it to you and Mark from here.
Thank you. Mark, are you there?
Good morning.
Good morning. I'm really well, mate. How are you?
Yeah, fantastic. Really great. Thanks for the opportunity to be part of the webinar, and hello to everybody at the FBAA.
It's going to be great. I think this one, Munch, I'm really looking forward to it. Now, I just need to let everyone know that we will go through a fair bit today, and we will have the presentation pack available for you so that you will be able to refer to this later on. And please, please, please use that chat function. We're really happy to address anything that you would like to talk about or any questions that you would like to direct to Mark or I as we run through this webinar. So, Mark, let's just, so that our listeners today know, a lot of them probably will know you from your days at GC. So if you could just give us a quick introduction and a background on yourself for those that are with us today.
Yeah, good morning, everybody. Yes, I'm Mark Munchenberg, basically working as a finance broker down here in Adelaide for Mayfair Finance. Really enjoying it, loving the role as a broker. I've basically worked as a BDM in SME lending for about the last 4 or 5 years, and yeah, really right across asset finance and various forms of cash business lending in those roles. I guess perhaps having experience on both sides of the fence has given me an opportunity to have a look at you know, what's happening in the market, you know, from both perspectives. And you know, I've gained a little bit of you know, had some lessons and some learnings along the way, and hopefully I can share that with you for everyone's benefit.
Absolutely, and I certainly know that where we've rolled this out already, that there's been some excellent feedback about being able to give that broker and lender perspective. So it looks as though everyone can see the presentation, so we've got it up there ready to go. So Mark, I'm just going to take us through the introduction slide, and then once I've done that, let's see. Okay, so look, we all know that the market for short-term cash flow funding is growing rapidly, and we know that a lot of SMEs have looked to alternate funding sources, whether that be because of speed, because of issues, or whether it's just to take advantage of that opportunity in a hurry, which I guess refers back to that speed. But we've also seen that a lot of lenders have increased their loan size in the unsecured space now. So, you know, we're seeing a lot of them do up to, you know, 500,000 and some even up to $1 million unsecured. And we know that the documentation has changed. And we also know, which is what we really want to talk about today, is the actual cost of this funding. We talk about seizing an opportunity or solving a problem, and we really should be looking at the cost of the solution as opposed to just drilling down into rate. But as a broker who wants to own that whole of wallet and really wants to be part of that advisory piece of their client, they really need to understand the different types of rates and how they actually reflect on a contract. So Mark, just take us through the current state of play before we start working through some of the actual examples we've got to work through today.
Yeah, sure, absolutely. I think you know, it's fair to say the traditional forms of cash flow funding businesses are used to using is their bank overdraft and their credit cards. Always been very popular, but can be inflexible for a lot of client needs. The bank overdraft in particular, if you don't have one, it can be a very onerous and long-winded process to actually get one approved and set up, and you know, that can take months. So if you're looking to move quickly, or you're not looking to put any additional security up, which you will always need with an overdraft, you generally need to put some bricks and mortar up for that. If you don't want to do that as a client, bank overdraft perhaps isn't the right answer for you, particularly if speed and ease is what you're looking for. So you know, that's led to credit cards being used quite a lot in business. Issues with credit cards, I guess, are keeping personal and business spending well and truly separate. How many of our business owners, you know, using credit cards for all forms of purchasing? The other issue with credit cards as well is that often the limits that you can secure aren't particularly high. You know, 20, 30, up to about 50,000 is pretty common, and a lot of opportunities do require access to more funds than that, so they are a little bit limited in that way. The other issue with credit cards as well is that the minimum repayment required is essentially interest only, and a lot of people fall into the trap of just making those minimum repayments and running up to the maximum balance allowed and never getting it down, and then it often turns into hard debt for them, hardcore debt for them, particularly you know, personally and in business. So you know, both of those options don't work for people in all circumstances. So this has led to the rise of short-term, quick and easy business cash lending, and there's been a real proliferation of providers and lenders that have come into that space, particularly over the last 5 or 6 years. And for customers, they see and hear a lot of noise about these products, and it's very hard for them to actually understand the differences between the products that they're looking at. And one of the key reasons for that is that the lenders themselves don't all have a common way of applying interest and expressing that interest, and therefore what the loan costs to people. And it's quite possible that you could be looking at 2 different products from different lenders, and the headline rate is the same rate, but the actual cost to the client over that life of the loan can be tremendously different. And it's important to understand, I guess, these ways of applying and expressing the interest and pricing of the loans, so that you can actually explain to your client that even though the price tag looks the same, one is a better solution for your client than the other.
Excellent. And Mark, that's probably a great way to really intro straight into our first topic, or our first cost solution that we want to talk about, which is simple interest. Now, I know that this can often be a bit of a lot of people think this is very straightforward, and it can often be one of the easiest to understand when you're looking at a 12-month loan term. When you're looking at then a 5-month loan term or a 36-month loan term, things can become very different. So I know we're going to use $10,000 today all the way through, just to make it nice and easy to be able to explain the differences by using the same dollar amount. So let's talk about the fixed annual percentage on the original loan amount of 10K when we're talking about simple interest.
Yeah, sure, no problems, Donelle. Basically, what simple interest is the fixed annual amount charged in interest over a 12-month period. The key with simple interest to understand is it doesn't work like other forms of interest. It actually ignores the fact that clients are making repayments over the life of the loan and the balance is reducing. So if you look to borrow $10,000, the interest is calculated upfront at the time you borrow it. In this example, it's 18%, and over a 12-month period, the annual rate, 18%, 10 grand, is $1,800 in interest. Okay, so it's pretty simple, pretty easy to understand. Borrow this much at a certain interest rate. That's the cash that you pay that equates to that interest rate. It's very simple and it's very straightforward. However, when the loan term varies either shorter than 12 months or above 12 months, you can come in for quite a surprise in terms of how simple interest works or is applied. So the traditional method of calculating it is the loan amount multiplied by the interest multiplied by the loan term. It's as simple as that. So if you look at the third example there, it's a 3-year, 36-month product. It's $10,000 multiplied by 18%, multiplied by 3 years. So you're actually paying $1,800 or 18% a year each of those 3 years. So 18% plus 18% plus 18%, totaling $5,400 in interest on an original $10,000 amount. If we go to the first example, which is a short one, under 12 months, it's calculated for 6 months. So that'll be 10,000 multiplied by 18%, multiplied by 0.5, giving you $900 in interest. Now, I'm going to make a really important point here about these loans that have got terms under 12 months. What I've shown in this slide, when I wrote these slides, this method of applying simple interest is essentially the global finance industry standard for calculating simple interest. But in actual reality, what happens is a lot of lenders they'll charge that 18% per annum interest rate based on 1 year, so $1,800. But if you've got a shorter term, they won't necessarily then multiply that by a fraction of the year. So at 6 months, yeah, you can see I've multiplied it by 0.5 to get 900. Yeah. A lot of the lenders in this space don't actually do that on shorter terms. They will just sit at the 1 year level of interest, being $1,800. Apply that over your 3, 6, 9 month loan. You're still paying $1,800. Just paying it in a compressed period of time, so your repayments are going to be higher as a result of that. It's something to really watch out for.
Yeah, look, I agree, Mark, and I think, you know, this particular product over a 12-month term, as I said, is great. It's easy to explain to the customer. It's a flat fee. You divide that by 52 weeks, and there's your payment, and it's nice and it's simple and it's easy. Yeah. And we are going to touch on this as we get towards the end of our presentation today. But one of the things to really watch out for, and I guess we'll call it a call out on simple interest, is wanting to pay out early. Now, we've all had those clients who say, I'm going to pay out in 3 months, and that never happens, okay? But there are clients who actually are, for a particular reason, as we spoke about, seizing an opportunity, so are looking to have that money back within 3 months. You really need to make sure that you understand if they are going to still be charged the full amount of interest that's being loaded on up front at the beginning of the period, and if there's any rebate, because as Mark has pointed out, quite often it will set up with the 18% over a whole year, and if you pay out at month 3, you've still paid $1,800, and then that becomes a really interesting calculation when you start extrapolating that out as to what then the actual interest is over such a short 3-month period. So just a call out on that one. Great product, easy to explain, but just when you're working around anything outside a 12-month period, less or more, just be sure that that you're loaded with the information that you need to share with your client.
Yeah, there's one other thing I might just say on this in terms of going to longer terms. Often you might get a quote from a lender for a 12-month term with a certain repayment level attached to that. Client can say to you, can I get a lower repayment? Could I look at a longer term? And yes, you can do that, and then you may be able to present an 18-month, 2-year or longer option, and the repayment is less. But they've got to understand that going for that extra length in term is going to dramatically increase their overall interest cost. You add an extra year on to get a lower repayment, you're actually adding double the amount of interest cost to the loan.
Absolutely. And it's funny, we talk about per annum. Actually, I'm not going to steal your thunder because I know that you love talking about mortgages. So we'll wait until that actually comes up. And we'll move on to total interest percentage. So again, it's an interesting one, and that's why we wanted to break these down, right? Because we see across the industry, very different. No one calculates exactly the same. So let's talk about TIP, as some of you may have heard, and your explanation on how TIP works.
Right, okay, so simple interest, we were basically talking about an annual rate. With TIP, what we're talking about is the total cost of interest, the total interest expense over the full life of the loan or the loan term, and express that as a percentage of the original loan amount. Okay, so again, we've got 3 examples here. Let's go to the second one, which is a 12-month, $10,000 borrowed at 18%. Over 12 months is $1,800 in interest. The total interest percentage on that, that's your interest cost against your original loan amount, is 18%. It's not showing you anything you don't already know with 1 year. But if you look at the next example below, over 3 years, same calculation, $10,000 at 18%, there's $5,400 in interest applied to the loan. The TIP, or total interest percentage, so this is your total expense, 54%.
Yeah.
Okay, so looking at an annual simple interest rate of 18%, this is where when you extend the loan out above 12 months, it can be a bit eyebrow raising in terms of how much you are actually paying in terms of interest.
Absolutely. I think, and again, it's good to call out that 6-month one. So you're right, and we do know that there are lenders in the space who do that for a shorter term, 6 months or 9 months. You know, we see that 36 or 26 week term, and they do calculate based on that term. But again, your total interest percentage, if that was still $1,800, oh, I always do this. There you go. I went one too early, Mark. But if you had a look at that and extrapolated that out, if it was only a 3 or a 6 month term and you were charged the full $1,800 as the per annum rate, it's going to look very, very different again. So total interest, a much larger number. Oh, a heaps larger number, larger than probably any number we'll see on the screen right now. If it was $1,800 over a 3-month term, it'd look quite horrific. So again, total interest, it's nice and easy to understand, and it's probably one of the figures that you should try and look out for, especially again when we talk about extending past that 12-month term. So one of my favourites, APR, annual percentage rate. Take it away, Mark.
Yeah. No worries. Now, annual percentage rate is very familiar and very comfortable for brokers and clients, because it's basically how everybody assumes and understands that the application of interest on a loan works. And this is why things like simple interest are a little bit surprising to people. Annual percentage rate, what it's all about is calculating and applying interest at regular stages through the loan in line with when people make repayments. So you will remember I said with simple interest, it ignores the fact that people make repayments and they just calculate it at the start of the loan and apply it. With this one, what you're looking at is the fact that a client is making a monthly repayment or a weekly repayment. Every time they do that, a certain amount of money is coming off the principal, and interest is applied for that week or that month on the reducing balance. So the fact that you have a reducing balance does a lot to reduce how much the interest actually costs you in cash over the life of the loan. I hope I'm making that clear enough.
Yeah, absolutely. And look, it's the, you know, for most of us, when we think about it, it's the old P&I type method, you know, so this one does work really well if you want to pay out early, because the interest is being applied as you're moving along. There may be fees, and we'll talk about that separately. But typically then when you request a payout figure for your client, or your client requests one, it's actually where the balance stands at that day, because the interest has been applied, as you said, either weekly or daily or monthly to the account. And that's where you will see that you will pay less interest, because you're only ever paying interest on that balance at that given time when the interest is applied. Yeah, exactly. So let's have a look at the example in the middle, the 12-month APR at 18%. Essentially, what happens is because the principal is reducing, the total interest cost over 12 months is only $1,001, because 18% is being divided by 12 months, so 1.5% per month, and that 1.5% is getting applied on the reducing balance. So yeah, as opposed to paying $1,800 a month simple interest, sorry, not $1,800 a month, $1,800 a year in simple interest, you're paying $1,001 over that same time frame. That's the effect of the reducing balance. And isn't that amazing? Just, you know, 3 letters.
So that,
right?
Yeah, the headline rate on the two products looks the same. They're both 18%.
Yeah.
But one's going to cost you $1,000 and one's going to cost you $1,800. Which one would you rather take?
Yeah, correct. And again, this is why it's really important, because to be honest with you too, I went, you know, through this a couple of years ago when I came back into the commercial space, and really had to freshen up myself, because, you know, you see all these different headline rates and you're trying to compare apples with apples, but unless you're looking for those 3 little letters, or you're actually searching for, you know, how they're charging, what type of interest or charges they're using, you can actually be quite well off the mark as to then what you're presenting to your client. And I love this example because it really shows that same 18% and 18%, but APR versus simple makes that a saving of $800 a month, $800 a year in this example to your client. So
yeah,
it really is worth drilling into.
Exactly. And if you look at the 36-month example there, the total interest charge is just over $3,000. Simple interest charge was $5,400. So there's a $2,400 saving for your client just based in the manner in which interest is applied and expressed.
Absolutely. Now, the next one is probably actually, to be honest, one of my least favourite ways to price deals is the old factor rate. And we're not seeing as many lenders using factor rate anymore, but there still are some out there. So take us through factor rate, Mark.
Yeah, factor rate is essentially a ratio, and it compares your total repayment amount over the life of the loan against the amount of money you borrowed in a dollar for dollar comparison. So essentially what it means is for every dollar you borrow, how much are you paying back? So if you look at the simple interest examples there, let's take the 36-month example. We know that there's $5,400 in interest on that 36-month loan. We saw that before. Essentially, for every dollar you borrow, you're paying back $1.54. At the APR level, 36 months, for every dollar that you borrow, you're paying back $1.30. So it's a very, it can be a very simple way of being able to show the difference in loans to clients when you're having this type of conversation, just breaking it down like that. And what it really, I guess, speaks to and reflects very easily is what your total cost of lending is. Yeah. And, you know, we spoke before about clients needing more nimble, more flexible access to funds to jump onto opportunities quickly. These interest rates, etc., can be scary, especially if we're mortgage brokers normally talking about 1.89 and 2.05. But the opportunity cost can make, you know, this level of interest absolutely worth it for the client if it fits their cash flow and it makes sense. And what they're looking to do is going to have a much greater return than what this costs, and it allows them to capitalise on it where otherwise they couldn't because they've got to wait too long for a overdraft, etc. Then this is the way to go. But you've just got to be able to explain the differences in these pricing methods so that you can compare apples with apples. Otherwise, it's trying to compare an orange with an apple.
Correct, and I think that's why with this one too, I've had probably some conversations with clients and brokers where they've seen this factor rate as a headline rate, and so it often can, you know, cause that bit of conflict too for our resi brokers who are used to speaking in those sort of digits. You know, it's not a percentage rate; it's a ratio. So don't think that you see 1.54. You know, and think that's 1.54%. Now, I know most of you know that, but your clients sometimes do not know that. So they may say to you, I've seen this at 1.54 or I've seen this at 1.30. Just make sure that they understand that that is a factor rate and is not actually a percentage rate. It's very, obviously, two very, very different things.
Yeah.
So, Mark, we've gone over the 4 common types of ways we see fees displayed in our industry. And so now what I want to do is touch on, we're going to talk about fees, out-of-pocket expenses, loan features, and some early payout provisions, and what we need to be aware of. Now, remember, this is information for you that you need to be armed with as a broker. We know that this conversations or the conversations that you're having with your clients are about the cost of the solution, but you need to be able to explain what that cost is. So, you know, remember, we've seen lots of things from our, you know, our great partners of the FBAA and of Lend at Strive, you know, the Coke can story and you know, what it costs to sell that can of Coke. It's just that you need to be confident in being able to explain that to your client. So, Mark, let's talk about fees, and I'll hand over to you for this one, because I'm pretty keen to have a bit more of a chat to you about some of the out-of-pocket expenses.
Yeah, sure. I think the biggest one is the brokerage that's involved and how that is applied to a loan and how that is reflected in the documentation to the client as well. You really need to understand how lenders approach that differently. The key is whatever the amount of brokerage is, it's generally referred to as a drawdown fee, or sometimes an establishment fee on these loans. And let's say the client borrows 50 grand, and let's say the brokerage on that is $2,000. Some lenders will get the $2,000 and add it to the top of the loan, and suddenly the loan amount becomes $2,000. Sorry, $52,000. Less a drawdown of $2,000, a drawdown fee. This is what they see on their documentation, and the client gets the $50,000 that they were looking for. All of their repayments and all of their interest will be structured around $52,000, but the client gets 50. Some lenders will take the drawdown fee out of the loan amount. So if the client's applied for $50,000, under that circumstance, the client receives $48,000 with the repayments and interest calculated on $50,000. So you need to be aware of these differences as well, so that you can be certain that your client's expectations are going to be met with the right amount of money hitting their bank account at the end of the day.
Yeah, I think if it's, if you're looking for, cash for working capital or maybe even expansion, being able to have that origination, drawdown, establishment fee, taken out of the funds is not such a big deal, and you can then have your interest calculated at the lesser amount. But if you're looking to pay out ATO debt or purchase some equipment, anything that's invoiced really, you need to make sure that your client's going to net in their hand what they actually need to be able to complete that purchase or clear that debt, whatever it may be. So I think that's really important to see. Look, we do also see, Mark, as you know, there are quite a few lenders out there who now absorb the brokerage. So we, we spoke about then that, on a $50,000 deal, typically in the alternate space, it'll be a 4% comms, which is your $2,000. But you'll see origination or drawdown or establishment fees sit between sort of that 2 and 2.5. So some of the lenders are actually absorbing the rest of the cost in the rate for your client. It's really only in those private lending type deals where you'll see the brokerage actually what some call mandated or actually listed on the contract. And that will allow some sort of flexibility around that. But you do see a range of different ways that our brokers are remunerated, either out of the rate or out of fees or actually added on top and shown on the contract. So again, just be aware of what you're actually explaining to your client when you're in that space. So cash out of pocket, this is an interesting one.
Yeah, okay. So basically, we've talked about 4 different ways of expressing price. We've talked about fees and remuneration to brokers, and all of that, by the time you go through it all with your client, it can get pretty noisy, confusing, bit intimidating, bit hard to know, maybe, am I making the right choice with product A or product B, even though you've made best efforts to guide your client to the right choice. So a really, really simple way to get to the bottom line on everything and just break it down for your client to make a simple and pragmatic decision between products is to look at, what is going to be your total cash out of pocket on product A versus product B by the time that you've put your application in and then got to the end of the repayment period. Simple. Once you total outlay over the entire life of the loan, that's cash out of pocket. And that cash out of pocket figure is the best way of being able to simplify it and show the client very logically the differences between product A and product B and what that's going to cost them.
Yeah, sure. Love it. I think you know, we see some cash out of pocket as well, again touching on that private space in our area. And I know you and I are both super passionate about this and about, you know, upfront fees that are paid before you even, you know, when you've got a letter of offer and there's not actually even an approval in place. You know, I think we all understand that it's reasonable to pay for a valuation as a client sometimes, and then if the deal falls over based on the value, well, unfortunately, that is just part of, you know, the situation in trying to obtain those funds. But commitment fees and big uploaded fees at the front when you're purely working on a letter of offer, guys, please just be wary of that. You know, talk to the FBAA, talk to you know, a finance specialist like Mark if you're new into this space. Just make sure that you really understand who you're dealing with and what their fee structure is when you move out of unsecured lending and into some of the other bigger products. And most of you know, private lending is obviously about equity and exit strategy and using the equity in your property. Just be really aware of some of those out-of-pocket upfront expenses that lenders may get you to pay. Sorry.
Yeah, I think it's fair to say that a lot of this cash business lending is very much in the unsecured space. It's the key point of difference. It allows for quick, simple, and easy assessment of deals, quick, simple, and easy approvals. So the speed is there. Some of those issues that you were talking about really start to rear their head when you get into larger deal sizes. Typically above 150, maybe above 200 with some lenders, and they're starting to think about, look, we need a security position in this. We can't just give cash with no security at all, and that's when you want to start to think about some of these other fees.
Absolutely.
Yeah.
All right, loan features, Mark. Let's we know that cost is obviously important, and we keep drilling this because it's really important that it's the cost of a solution. Are you going to be able to buy that stock in a hurry and turn it over for 3 times as much because you can pay for it cash up front?
Yeah.
And in a couple of days. Are you able to clear out your ATO debt so that you can buy that, you know, investment property or do the renovations on your home and refinance your home loan? Is it about that you're about to come out of lockdown and you need to go and find 10 staff because we know that the Aussie spirit is from the 18th of October in Sydney, it's going to be game on, and, you know, retail stores are going to need to be stocked up and they're going to need staff and all of those sorts of things. So we've spoken about the cost, but what are some of the other things that are important in the actual product itself, for some of the features that may be really important to the client?
Look, I think number one, the assessment process is a real key feature to the products and how that works for the client and their needs. You know, we've talked about, you know, relatively high interest rates and high interest costs, but you can balance that off against things like, you know, a simple online application process that you can do in literally minutes, a credit decision that comes back to you within hours versus weeks to months with an overdraft. Other features, you know, that speed of the access to the funds. You know, you mentioned, you know, stock opportunities and things like that, you know, clients need to capitalize on. Very often that, you know, those opportunities come along, it's Murphy's Law, right when they've got no money in the bank, and, you know, the money's coming in next week on you know, a work contract, but they've got an opportunity to buy something this week, but the money just ain't there. So speed of access to funds, you know, same day funding is possible, you know, with a number of these lenders. You know I did a $100,000 deal only a few weeks ago, and from application to settlement for this client, it was less than 36 hours.
Yeah.
You know, it's really quite good. So these are some of the features that, you know, are important to clients, important to you as brokers to know and understand how they vary from lenders, so you can drive the client to the right product for the specific circumstance and need that they have. Other things are like, you know, redraw features. You know, are they available? You know, if I'm partway through my loan and I've paid down a certain amount of principal, if I need some more money, what do? Do I get another one of these loans, or can I go back to the same loan that I've got and maybe take some of that principal back out? So redraw features and things like that. You know, you just need to understand what your client's looking for. And also, there's been a big rise in the last couple of years of the revolving line of credit in this space as well. So line of credit, non-bank overdraft. There's a couple of different names for it, but it essentially generally means you're approved to a certain limit. You can use as much or as little of that limit as you need, and you pay for what you've taken for the length of time it's out the door. So you might have a $100,000 limit, you might take 30 grand out now, and you know that you're getting a windfall of cash in a couple of weeks' time. You can put that $30,000 back in and you've only paid interest on it for a couple of weeks. So there are flexible products like that out there as well.
And I think too that sort of revolving line of credit, and again, Mark, it has to be what's right for the client. And some of the great examples where we've seen that line of credit work really well is for those lumpy, inconsistent income type clients, because what it allows them to do is it allows them to pay it down really quickly when they're busy and they've got lots of income and they pay very little interest. And then when they're quiet, it actually allows them to keep running the normal day-to-day functions of the business and utilising it then. So that's where I've seen some really great impact of that revolving line of credit, is that lumpy, inconsistent type income users. Or again, it's like we touched on at the beginning with overdrafts and credit cards, those that are really disciplined. You know, so their money comes in, they pay as much as they can off their revolving line of credit, then they wait till they need to use it again, and then they pay it, and they continually cycle through that way, and that can be a great way for them to pay less interest on the deal as well. So, all right, love this one. We've seen it pretty much wiped. That's not 100% in our side of the business, but let's talk about early payout provisions.
Yeah, this is a really important one for, again, making sure that you're matching the right loan product for your client's needs. It's you know, we've gone on a lot about interest rate, and we've mentioned a lot about total cash out of pocket over the life of the loan. They're really, really important considerations for the client, plus speed and ease of access. But you know, one of the really important things is you know, what happens if your client actually wants to pay the loan out early? And you need to understand the differences from lender to lender. They have different ways of approaching that scenario, and they range from basically no early termination fee at all, simply at wherever the client is in their loan, whatever the outstanding principal balance is at that point in time, you just pay that plus any arrears if you have any, and the loan is closed off. And you know, the lender is happy they've made a certain amount of interest off from you off the life of the loan. And as we know, the payments are structured that the majority of the interest gets paid early in the loan. So you've got that, you know, basically, you know, no difficulty for a client. At the other end of the spectrum, you will have lenders that will basically look at the net present value of the unbilled interest. So how much interest is left to be paid on this loan, and they will look at that and either charge it in its entirety, or sometimes discount it a little bit. There might be a 10 or a 15% discount, and then apply an early termination fee on top of that outstanding interest charge as well. So I guess that's kind of two ends of the spectrum, and you know, there are some lenders that play in the middle there as well. So important to understand where you're at, because if your client is giving you any signals at all that they're interested in paying out early, well, it is so important that you look at the early payout provision on each of the products that you're putting up to the client to consider.
Absolutely. And you and I have both seen some horror stories, and I'm sure there's lots of people on the call today that have seen that as well, where it's actually not in their best interest at all to pay it out early, which is actually quite sad. So
Exactly.
look, I'm going to skip the conclusion, because what I really want to do is just first of all give the guys a bit of a heads up that we're sort of in the last 15 minutes. So if there's anything you want to put in the chat function that you would like to ask, now is the time. But before I stop sharing and you and I sort of wrap up today, I just want to run through a couple of these examples where we have, you know, this real need and this real opportunity to display and explain why this type of funding is not something to run away from. So I'll take the ATO one and you can take the next one. But you know, here you've got the example of the clients looking to make a sizable borrowing for asset finance or commercial property, which is actually what we spoke about. It can even be for residential property, but obviously they're a business owner, so they're looking at holus bolus of that particular client. They'll often be hamstrung by ATO debt. So many tier 1 lenders take quite a dim view of outstanding ATO debt, regardless of whether you're in an arrangement or not in an arrangement. And as we all know, that can actually sometimes impede their perceived creditworthiness, which most of us know is actually probably not really reflective in most cases, especially when they're under an arrangement. So their current tax is up to date, they're paying that regularly, and they're under an arrangement for previous tax. You've actually got someone doing the right thing there. So if they're in a payment plan, even if it's deemed manageable, one missed payment actually ceases the whole arrangement with the ATO. So you can be 3 or 4 days late, or you can just skip one payment, and they can then, the ATO actually can then call in the whole of debt. So that's something to be wary of as well, especially if you're going through this refinancing of property or buying a property or doing asset finance where things might be just tied up for 6 or 7 days. You cannot miss those payments when you're on a payment plan.
Yeah,
but by paying, you know, you go, Mark.
I was just going to add in there. So, sorry, Donelle, it's important to understand a lot of clients historically used ATO debt as very, very cheap form of credit. The ATO historically wasn't, you know, terribly gung-ho about calling people in. And yeah, it really led to a lot of businesses leaning on their ATO debt to plug cash flow issues. But that has changed. About probably 3 years ago, the ATO started putting black marks on people's credit files for missed payments or broken arrangements. And the idea of them garnishing earnings has become a lot more prevalent. So your tier 1 lenders, when they see an ATO debt, they get nervous because they know that if the client doesn't meet that religiously, it could absolutely destroy the client's ability to service the loan that the bank is looking at giving them. So clearing the ATO debt is a great way of avoiding that risk to serviceability of a bank loan when you're applying, you know, for a large bank loan for asset finance or commercial property.
Correct. And look, one of the things that we don't really talk about a lot either is, you know, everyone says, oh, the ATO, you're right, it's cheap, it's a cheap way, the interest rate's cheap, this is cheap, that's cheap, but it's not cheap when it hamstrings you from taking either, again, that advantage of an opportunity, buying another business, expanding your business, whenever you need to go and access funds from mainstream. And we haven't got time to delve into those figures today, but think about the difference in placing or being able to facilitate your asset finance or your property or your, you know, commercial or resi property finance with a tier 1 lender. Versus, you know, and we're talking in those 1s and low 2s at the moment, Mark, as you know, versus needing to be talking in, you know, the 6s, 7s or 8s, because you really need to use a completely different lender you know, not even so much second tier, but when you move into that third tier property lenders, what is the savings that you make by being able to get, you know, that money through a tier 1 lender as well. So don't just think about the impact on the business and having a clear ATO but it's cheap, paying it off with them. It's actually how you're perceived, how you personally and your business is perceived by the big lenders when you've got ATO debt, and how that can stop you from moving forward with something you want to do. Now, the next one, short-term stock. I don't even think that we probably need to dive into this one too much, Mark. We know the opportunity here. You know, you've got containers down at the docks. You've got the opportunity to buy a $250,000 worth, you know, container worth of stock for $125,000. But where do you get $125,000 from? So, and quickly, because that's typically how it works. This stock's become available. This person hasn't picked it up. This has been triple shipped, so we've got overstock. It's always quick. It's who can come in first with the cash. And so we know that opportunity, and it doesn't change the price that you then retail those goods at to your client. So you're still making the same margin. So again, that's another great consideration in when you're looking to offset the cost. You're still selling that, you know, as we said, Coke can. You're still selling that Coke can for $3. So if it's cost you $1.04 to buy it instead of $1, everyone's going to do that deal, right? So stock is a really easy one to be able to explain. I'm going to give this one to you, Munchie. I love this example. Talk about the business acquisition or expansion extension.
Oh, right, okay. So this is a real example. This was one of my clients. Basically, they're an existing cafe operator, already had a couple of locations. They were doing quite well at them, as well as can be expected under COVID. You know, there was another business, another cafe type of business that had failed. And there was an opportunity for my cafe owner to pick this business up for simply the cost of plant and equipment, stock and equipment, okay? But they needed to move quickly. If they couldn't pick it up, liquidators were going to jump in there and basically sell off all the fittings and fixtures and so on out via auction. So yeah, they definitely needed to move fast on this. So we basically got them a cash business loan to get the funds they needed very quickly. From a serviceability point of view, they were assessed on the income and earnings from their 2 existing cafes, and it serviced, it worked, just based on that. And they were able to take this business over, get it trading very, very quickly, and then obviously they had the income coming in from that one as well. So the opportunity cost for them was a very cheap buy-in to a third location that was going to give them a third revenue stream. They knew if they ran it the way that they had run their other 2 businesses, it would be successful in this location. So the cost of interest on the loan was very, you know, very easy to rationalise and offset in terms of that opportunity.
Absolutely, and you know, you can't wait, especially with acquisition as well, or expansion, new premises. We know that they can take considerable time to get through mainstream or first tier lenders. So again, you know, it almost becomes irrelevant, the cost of this solution. It almost.
And this was literally done in a couple of days.
Yeah, easy, so good. Taking on a new work contract, and we've seen this regularly, and we're probably seeing it even more so now, especially with COVID. You know, for an example, if we talk about you know, construction and trades, you know, we know that it's very hard to get materials, that there's a lot of delays in first tier lending and progress payments, and you've got, you know, builders who are needing to move their subbies and stuff from one place to the next. They need to keep paying the wages of those guys to start, you know, the next job or the next new contract. It can even be seen as that. It may be a brand new contract that's come up, but even just the next job that's already ready to go, they need to keep paying the wages and need to keep paying those guys while they're waiting to receive their payment. So again, if that's a 4 or 5 week delay, sometimes it can be that short term of funding that you need. Again, the cost becomes irrelevant because you need to keep paying staff. Do you want to add anything on to that one, Mark?
Oh, look, I think one of the important considerations across a whole range of these opportunities is which form of this funding is right for which situation. Do I look at a term loan over a given payback period, or do I look at a revolving line of credit? Which one's going to be the right one for my client? And I think it really comes down to whether your client is doing something that is more of a sort of a one-time only expansion, acquisition, that type of thing, very much a term loan proposition. And they may have those opportunities down the track. But what you want to try and avoid is situations where clients are feeling like they need to stack a number of these loans up on top of each other, you know,
Correct.
within the same time window. Because if you do that, you know, then suddenly serviceability and affordability and the impact on cash flow becomes quite an issue for the client. So if you've got a client like that, where you can see that there's going to be a regular and recurring need for some cash injection, then the revolving line of credit is a far better way to go for the client. So just bear that in mind. Yeah.
100%. So look, that we've filled in 57 minutes, Mark. I know you and I are both really passionate about this topic, and I certainly want to say thank you again to you for joining me on this ride. We've shared this information across a few networks now, to the Lend Network and to a lender broker network, and now to be able to share it with our great friends at the FBAA is really important. So really appreciate the time that you've put into this. Also to the FBAA for allowing us to share this information. As I said, sometimes it's scared to admit that you don't know what you don't know. And so we hope that we've made it a little bit more enjoyable and a little bit more understandable today. And then most importantly, to all of you who've signed in today and given up an hour of your time to listen to Mark and I, we both really appreciate that too. So thanks, Mark, and back to you, Leah.
No worries. Thank you.
Thanks, Donelle. Thanks, Mark. And I'm sure that everybody has taken so much on from today. There is a question sitting over in the chat box at the moment, aimed for either of you to answer here, and it's coming from Islam. He's wondering what documents ideally are we looking to get from our clients. So either one of you want to elaborate on that for him?
Yeah, so when you're looking at unsecured lending, primarily it's done off of bank statements. So the client's business trading accounts, okay? And often it's done using an electronic link that either the lender supplies, or if you're registered with aliensbankstatement.com yourself, you can use that link and get those latest PDFs of the client's bank statements. Most of the assessment's done on that because the bank statements are the raw data that show all the trends in a client's business up to the minute. So you're not relying on last year's financials or the year before's financials. Bank statements feed and create all of that data, obviously, but it goes through an accountant, can be modified to appear good. The bank statements, though, are what most of these lenders go straight to because it shows an up to the minute picture of where the business is actually at right now. So that's number one. And then just generally your sort of your typical AML stuff, your IDs, that type of stuff.
Yeah, so nice and easy, privacy and consent, photo ID, bank statements for deals under 150K. If you're over 150, there are lenders that are really stretching out that unsecured amount now. And once you get over that 150K mark, you may be asked to provide other documentation such as financials. So that's just a call out. When you get to the bigger unsecured loan amounts, you will need more than bank statements, but under 150K, easy.
Yep. And just to clarify, guys, they are actual bank statements, not transaction histories.
Correct. Yeah, unfortunately, fraud is, everyone pretty much is using one of three suppliers in Australia now, whether it be Cash Debt, Credit Sense or Illion, seem to be the three typical ones. And what this really does is it protects you, it protects your client, and it protects the lender from fraud. So please don't send CSV files of transactions exported. It just
not even PDFs supplied by the client. They can be manipulated very easily as well. The electronic link is secure for everyone, and it's real and it's verifiable. Yeah, 100%.
Yeah.
I think that's important to also remember, for the simple fact that there are a lot of people out there, consumer-wise, that do hesitate on using things like bankstatements.com because of the concerns of cybersecurity and obviously their personal information being protected as well. So there's a great assurance from them that it is completely secure, it can be traced, and that your client should have no adverse reason, realistically, to be using a system like that.
Yeah,
one other question that's just been...
I think the client's concerns about security with using bank statements, they're real and legitimate to feel that, because the trust factor is not necessarily high with internet-based stuff. But basically, how I get around that and give my clients comfort is I say to them that the bank statement link, it uses bank level security, and neither that provider, if it's bank statements or whoever, or us as brokers, will see their log-on information or can retain their log-on information or have any further access to their bank account. It's a one-time only, read-only delivery to us, and they're generally quite comfortable if you explain it in those terms.
Fantastic. We've just got one other question that's just popped up from Andrew Beckett, guys. He just wants to get both of your thoughts on Smartbox, which is listed at the back of the loan agreement. Can you explain this a little bit more for the people listening, because it does come through on a loan agreement?
Bex, I could always rely on you to bring up Smartbox. Not every lender participates in Smartbox, and the way that some lenders actually demonstrate their fees, whilst it is meant to be something that is generic across those that do participate, still demonstrate whether fees are included in certain rates or not. That can vary, but it is a tool to help you to be able to explain to your client the cost of the loan. So Mark, I know we've got to wrap up because we've gone over time, but do you just want to add a little bit more, because you've had a lot more exposure to Smartbox than I have?
Yeah, I guess what I'd say about Smartbox is that there's a banking code of practice which a number of these unsecured lenders are signatories to, and I think that number is 6. I think there's 6 of these lenders, and part of that banking code of practice is to try and it makes it incumbent on lenders to be fair and transparent with their pricing costs and fees, and that is the role of the Smartbox. The Smartbox helps to express the pricing in different ways, using different metrics to try and make it easy for the client to understand what they're actually looking at. And I think the Smartbox is a great initiative. I think the only issue I have with Smartbox, and this is a personal opinion, is that it's delivered too late in the process. It's delivered with the loan documentation. And it really, if it was delivered upfront at the quoting stage, it would make it easier for brokers and clients to be able to compare apples with apples. That's
fantastic, and I think that's some great feedback on that one as well. And look, I've learned something today as well, guys, with the whole Smartbox function. So I do thank you for your input on that as well. Hopefully for the FBAA members, and I'll just highlight something that Mark said then as well. The banking code of conduct is something that the FBAA did request all members complete, and that should have been done by now. So if you haven't done it, can you please log into the members area and complete that as soon as possible? That will also give you some more background as to what Donelle and Mark were explaining today with the behaviours of a lot of credit providers out there. But it will make sure that our members are also compliant with what they're doing underneath the banking code of conduct. So guys, please do make sure that you do get on and get that done. We did have a deadline for earlier this year on it. If you are a new member, you will need to have that completed as a part of your compliance fundamentals with the FBAA. But Donelle and Mark, I want to thank you both for your time this morning. I'm sure that everybody like me found it educational. I walked away learning so much more about business lending. And Donelle, as you're aware, it's not my favourite area of finance, but look, more and more, every time I sit through these webinars, I pick up so much more on the business side of things, and probably shouldn't have stayed away from it for as long as what I did. So thank you both very, very much. They say you can't teach an old dog new tricks, but here I am still learning. So guys, I do want to thank you both. If there are any further questions, please guys, send them through to me. I'll forward them to Donelle on your behalf. Alternatively, the FBAA will be sending you Donelle's details in an email following this webinar this morning. We will also be putting today's webinar up onto the FBAA's YouTube channel, which you can access directly, obviously, through YouTube. And the link on that will also be sent out on the email following today's session. So I do want to thank everybody. You have gained yourself 1 CPD hour if you have lasted this long with us today. And if you need anything from the FBAA as well, please contact myself or Mark over on the West Coast and let us know. But guys, for now, it's hopefully we'll see you all soon, and hopefully this lockdown's not going to be around for much longer.
Thanks so much, everyone. Have a great rest of the day.
See you later.
Bye for now.